All right, so welcome to this special bonus video where I'm going to be showing you my Strategy Quant X workflow for data mining seasonality. So what we've done in this series has largely been to look for bias. So we find some effect in the market um, that we think is there and at least has seemed to be there recently. You just look at the chart and you scroll back a bit and then you say, okay, now I need to back test this because I think there's something here with this idea. And oftentimes, the first time you test the idea, it shows some sort of promise, but your initial idea on it may not have been the best, and so you have to keep refining it until you've either decided, okay, the effect is only sort of there and really not that good, or you've finally found a set of parameters, ideally with not too many entry and exit conditions, that allows you to take advantage of that effect. And so one way to mine for seasonal effects is use software like Strategy Quant X. There's other tools out there as well, like Build Alpha, and then I think the other one is some genetic. I don't remember what it's called, GRC or something. But I like Strategy Quant X because I can automate not only just the build step, but also a bunch of the other checks. So here I'm in a custom project that just is first going to start with clearing all the existing data banks. So um, I have about 8 data banks, and the initial build step is going to put uh, the algos that it builds in here, and then each of these steps, like recency, is going to do additional filtering, um, and then eventually filter. And so here you see in this one, specifically mining for intraday strategies, and I ran it for 3 days, and it found 26 strategies, and then I decided, that's enough. Let's see if any of them pass all the way to my final filters at the end, and one eventually did pass. So that's kind of a good way to think about it. Usually, if you're buying a software like this, you're going to be running it for days, if not weeks, because it's. I wish it would show how many strategies it generated after I stopped it. But it had, I ran it for 3 days and it generated about 2 million strategies, rejected 99.99% of them, found 26. And then, that's when I manually hit stop and just had it go through the rest of the filters. And then here, what you'll notice is that all this is showing is the strategies that made it into the initial results. The strategy that made it to the final 104 is not actually shown here. So this is just kind of like a misleading. I don't even know what this is. This best strategy so far is really not the best strategy after it's gone through all the filters. Uh, and so the first step is to just clear the data banks, clear all of these, just so that it's not using any strategies from the prior run. And then for build algos, this is one where there is going to be some human input. So in this series, we've talked about the long bias with SPY. And since this was an intraday ES strategy, specifically for one of the prop firms that I'm getting accounts for, I set it to long only. And so again, whenever you think about effects and biases in the market, you generally want to think about them in one direction and not both directions, just because long and short tend not to be the same. They tend to be asymmetrical. And so and also there typically is a bias in a direction. Some instruments may show a bias long in certain hours of the day and then a bias short in other hours of the day. So you may consider a long short there, but I would consider those two different effects and to actually mine and analyze those separately rather than trying to do them together. And then for build mode, I think genetic evolution is far superior to random generation, because genetic evolution is similar to what we're doing when we look at the chart and we say, hey, there seems to be a recent effect or recent bias here, and then you keep going back, and then you code it so you can back test it, and then you look at those results, and then you kind of refine some of the filters or conditions that you used for the entries. And effectively, that's what genetic evolution is it's saying, hey, there does seem to be something here, but it's not good enough yet. Can we keep exploring this? Whereas random generation just is completely random. And then in terms of numbers of conditions, I think it's important to keep these low. I would say you probably don't want more than 3 entry conditions. Exit conditions, you probably don't want more than 3 as well. I like to use 2 though. Um, and in terms of the number of exit types, I think I think 4 is what's reasonable given mine, but I typically just set this at 5, which I think is the default, and that's because you have entry conditions, you have exit conditions, but then you can also have a stop loss and a profit target, and so that might be an additional exit or a way to exit beyond the 2 that you have here, and so I think that's fine. Um, I mean, most of the strategies that I see, typically the only exit is a stop loss, a profit target, and then one exit rule, um, 1 or 2 exit rules, I should say. So I'm still not entirely sure what this number here even does. And then what I like to do is require a stop loss for data mining. It depends on the strategy. If it's a mean reversion strategy, I may not require a stop loss, but if it's something where I want to capture an intraday bias, then I like having the stop loss on because I already know that SPY has a long bias. I know that ES has a long bias just because it's the futures version of SPY. And so I don't want it to sit there and hold saying, yeah, we can hold for most of the day because of the long bias in this instrument. I'd rather require a stop loss so that it can reject a strategy that I don't actually want to run. And then profit target. Again, this one, you really have to think about what you're building here. If you're building on the daily chart, profit target may not be required. An exit condition might be better. If you're trading intraday, I like to use profit targets just because I think you get slightly better strategies than if you rely solely on exit conditions for profit targets, or rather, solely on exit conditions to take profit, I should say. And then I usually leave the genetic options just as the default. The only filter is that whatever it comes up with has to actually be profitable, which means the profit factor has to be greater than 1. And then data. I trust data from TradeStation. I think that a lot of the other data providers don't necessarily have the best data. And so I have exported all of my data out of TradeStation. So you'll notice that these are a lot of futures instruments across US equities, some currencies, and some commodities. And I exported the 5-minute data from TradeStation, and that's typically what I use. And then here I have an in sample. So for US equities, I like to start from 2007. For commodities, I like to start from 2010. And the reason for 2007 for US equities is because that's when electronic trading, or that gave it, I would say, a couple years for electronic trading to really take off and kind of become the norm. And for commodities, it's the same reason. Electronic trading for a lot of commodities started in about 2008, and those markets were adjusting to the electronic market. And so the way those markets behaved in 2008 is unlikely to be replicated ever again. And so I typically like to just say, hey, let's start with 2010 on the commodities. And then I ran it up to 2019, but there's an in sample and out of sample. So notice that the out of sample starts near the last quarter of 2013. So effectively, it has from 2007 to most of 2013, almost 6 years to look at the data and say what are some rules that would yield a profitable strategy in this period. And then from the last quarter of 2013 to the end of 2019, which is another 6-year period, with those same rules, have still been profitable. So that's the first out of sample. And then in terms of trading options, again, this was set up specifically for a prop firm that I'm getting accounts for. So we have to exit at the end of the day at 4 p.m. to make it an intraday strategy. And then I have a time range from 9:30 to 11:30. And this is something that I really want to emphasize because I have talked a lot about time in some of the previous strategies and bias and seasonality. And when it comes to intraday, it's the exact same thing. Rather than just saying, hey, let me just add these rules and not have any time range, in which case entries are allowed, I'll just let the strategy run overnight, pre-market. It can take trades. And I feel like that is how you end up with a lot of intraday strategies that just don't work. You really have to sit there and look for a time range in which you think that particular bias or that strategy would make sense to run, and then say, I'm going to limit the entries to that time. And in my opinion, that is the best way to come up with strategies, at least seasonality wise and bias wise, and probably just in general, come up with algo strategies. Is you start looking at time. Everyone's obsessed with price, but time, in my opinion, precedes price. Time and volume. Volume's a little bit harder to data mine for and to evaluate, but time in particular precedes volatility, which then precedes price, if you think about it. So start with time. You have an idea, figure out the time range where it makes sense for taking entries. Again, your exits don't have to be within that range. And notice I've got exit at end of range off, but your entries should probably be contained to a point where there is sufficient volatility, or not volatility, sufficient volume in the market, and where your idea should, in theory, make sense the most there, as opposed to just saying, oh, hey, I'll just run it at all times that the market's open. I don't think that that's a very good way to build a strategy. And then building blocks, these are what the genetic options are going to use. We've got signals, which are the reason for taking the entry. So it could be like the ATR is falling and then falling below some level. ATR is rising, could be volume is rising and has been rising for the past 10 bars. There's time. Again, I really want to emphasize the importance of time in its relation to effects in the market and bias. And then a lot of these are, again, the signals are just the ones for taking the trade. I don't think it's important to turn on all of these unless you specifically believe that it'd be relevant. And that's just because the more of these that you turn on, the longer it's going to take to mine, because it's essentially trying to put together random garbage that may not make sense. And that's kind of the trap that you fall into if you get software like this, is you just go in and you turn on every single thing and then just have it run for like a month. It's going to take a long time. You'll be more efficient if you think about the effect. Think about the bias of the market that you're trying to mine for. Already have a time frame in mind that you want to see if there's a biases there, and then turn on the signals that make sense for that bias that you're mining for. And time-based ones like day of the week, hour, day of the month. Those tend to be really strong. And the indicators are like an additional condition. So if the signal is the reason to enter the trade, indicator is an additional filter. So it might be like, we got the signal, but for us to take the entry, we need to be above the exponential moving average. So that might be an additional condition. So that's what the indicators are really for. And then you've got your stop loss reasons. And I think the important thing is to think about these as well. Don't just turn them on. What I often like to do, because I really don't know what some of these things are, and so I'll have a project data mining, and then I'll be like, okay, I need to go research what the heck is Vortex, what is what's a Ichimoku. I'm probably never going to use Ichimoku, but I start researching some of these other things I've never heard of in my spare time while an existing project is running. And then I don't do any sort of position sizing type stuff. I typically just use a fixed size of 1. And then I don't do any cross checks at this stage. And then for ranking, I've set 1500 as the maximum to store before it moves on, but usually that's just a generically high number. I usually stop it at something like 25, 50, sometimes 100. And then for the filters, so we have our initial filters where the genetic algorithm, or the genetic evolution, is trying to build algos, and they're rejecting any that are not profitable at all. And then we have an additional filter that says don't even put it in the results data bank if it doesn't meet these criteria. And so again, you really want to tune these just based on what you're trying to do. I personally don't like to run strategies with a profit factor of less than 1.5, and since the actual profit factor of a running strategy is going to be worse typically than what you back tested. I like to set this to either 1.6, 1.65, or 1.7. I think it's difficult to run a strategy that wins less than 35% of the time. But you also don't want to set this to something high like 80% because your goal should be to build a bunch of strategies that kind of work together, like portfolio strategies, and those will have varying amounts of winning percentages. And again, I wanted at least one trade a month, but preferably not exactly one trade a month. So that's why I set this. And again, you can just kind of research what these mean and kind of why you might want them. The other one is stability. This is basically saying if you have high volatility in the strategy's results, then it's probably not a very stable strategy. If it only works, if it pretty much only works as a volatility strategy, then you probably don't want to run it. And then the automatic filters I use are discarding strategies with no trades, discard strategies that only met the criteria if they had one huge winning trade, and then too many trades closing at the same bar is usually a data issue. So you'll notice I previously mentioned that we go from 2007 to 2019 in this initial build. We have 6-year in sample, roughly 6-year out of sample, and we're still missing the years from 2020 to 2024. So that's what the recency is for. It takes those same rules for those strategies that it built. So in this case, it built 26. It's going to run them again with the same rules, but from 2020 to 2024, and ask, were they still profitable? Did they still meet the conditions from 2020 to 2024? And then the ones that did will go into the recency data bank. So you notice we went from 26 down to 3. So 23 failed to continue to perform from 2020 to 2024. And then full time span, all this does is it just takes the entire 2007 to 2024 range and then puts it together and then reevaluates again whether that full time span would have still met most of my criteria. I tend to be a little bit more lax on the full time span and not require 1.7 profit factor. I tend to use this to look at the strategy and think about it, and that's just because sometimes you have situations where we arbitrarily chose 2013 as like the cutoff point. There are times where your decision to pick a particular start or end might affect things in terms of how the full-time span looks. And so I usually am a little bit more lax here, and I like to see, well, it passed this step and it passed recency. If I stitch it together in the full-time span, usually performance gets a little bit worse than in recency or in the build algos, and I like to just kind of look at it manually and analyze. Then we have Monte Carlo, which I'll cover a little bit more in this month's strategy video when I talk about Monte Carlo and how it really works and why it's useful as a robustness check. And then we have correlated markets, which you can turn on or off, but really that's just a cross check here, where I turned it off just because I didn't set it up the last time, but usually I turn this on, and then you set some other markets to test on, and the only condition is that they have to be profitable. So this is actually one of the best robustness checks that I've seen, which is you need to make sure that the strategy works on other markets. So if you think about or rather, when I say other markets, correlated markets specifically. So if you have a strategy that works on ES and then you test it on NQ and it's not profitable, then you have a problem, because NQ is like 40% of ES. And so I bring that up just because that's probably one of the best robustness checks I've seen. And there's all sorts of theory. If you go on the Strategy Quant website, you'll see all sorts of theory as to why other robustness checks are good and why they make sense. I have not necessarily seen them hold up. So a common example would be, if your strategy works on the 5-minute time frame and you jump to the 10-minute time frame, it should still work. Well, that's not actually true from my experience. The 10-minute obscures some of the data from the 5-minute time frame, and so you might lose a little bit of the edge there by going to a higher time frame and basically waiting longer. And so I don't actually like that as a robustness check. I don't think it has held up in terms of taking a strategy and then, okay, I discard it because it didn't work on a higher time frame, and then I watch that strategy incubation and still working on its original time frame. And so I think some of the robustness checks that are published out there are just theory and don't actually hold up when it comes to real life performance. Then there's system parameter permutation, and what this does is it just takes the values for the indicators, and then it checks similar values. So it's sort of like saying if you have a strategy that used like, let's say, a 20 EMA, and then you change it to a 21 EMA or 22 EMA, does it still work? And if it doesn't work, then you probably have a problem. And then, of course, you have final filters, which is really just a way for me to stitch together. All it does is rerun like all the other retests here, just so I can see at the end what it looks like. And so here, if we look at the one strategy that made it, and if you look, so we have the full, I usually typically just look at the out of sample, which looks like the way I set up, I only stitch together recency. This is an example of how we went from 26 strategies down to 1. It took 3 days to mine those 26, and then it took probably like 30 minutes to round them or to filter them out down to this one. The sequential or the system parameter permutation and sequential optimization, this is kind of what it's looking for. So it's saying that the optimal value in the past was 15 for the SMA, but the value that was used in strategy is 19, but that was still considered a stable value. So here you look and you say, okay, those values are pretty stable. They had relatively similar results. So here we used 19, which is a little bit, I think it's this blue bar over here. Optimal would have been 15, but it's what we got was pretty close. This entire section here is relatively close in the performance, and so that's what you want to see, is that it finds a stable area. And then, of course, you've got list of trades. I like to look at this as well just to make sure that there's no data issues and that the list of trades, so like you've got the maximum adverse excursion, this is like your intraday drawdown. I just like to check these and make sure that they actually align with what I expect out of the strategy. And then, of course, you've got your equity chart. This is the in sample. Here's the out of sample. You can analyze the trades. This is also a great way to check for seasonality, determine if maybe you shouldn't trade in December, maybe you should not trade on Fridays. And then, of course, we've got the Monte Carlo. This big blue line is the actual, and then it says the majority of, randomizations of the data would have produced a general upward slope. So there's a high chance, about 95% confidence, that you're probably going to make money. And then you can get the source code for the strategy whenever you look at that section there. So that's how I use Strategy Quant X, and then I typically take it, the source code, and then I convert it into PineScript just to confirm that there's no other like crazy, just to confirm that the results are not wildly different. Unfortunately, PineScript, I can only go back about a few months on the 5-minute chart, and so we've only got a sample size of 7. But when I look at the trades, the drawdown, the P&L, it does seem to be behaving as it should. And so that's just what I do in terms of seasonality. I typically use Strategy Quant X to mine, and then I go over to PineScript if I'm happy with the results, and then I code them up in PineScript just so I have a different data feed that I'm checking the results against. And then if I like it, then I'll consider automating it either in TradeStation or Quantower or like Thinkorswim. So hopefully this video made sense. Hopefully you enjoyed it. And if you're interested in this workflow, I intend to share it in the community Discord. And then if you're also interested in talking to me about Strategy Quant X, feel free to shoot me any questions in the community. And yeah, I'd love to see more people share how they're using tools to help them develop algo strategies.